even if you're a short-term trader trading on, say, a 1 minute or a 5 minute chart, it does help to look at longer-term charts as well. And our guest today, Corey Rosenblum, does a lot of that to help him make trading decisions. So, Corey, how do you combine, say, a 1 or a 5 minute chart with an hourly, even a daily, or longer than that?
Sure. Let's take the example of a major, obvious level on the daily chart. Let's say the zone of 1200 on the S&P. That came into place in November 2010. It was a very great opportunity for intraday traders because that level served as resistance. But on the intraday chart, once that level broke, we had what we call a pop-stops impulse. Traders that were short above that level had to cover. And of course, anyone that was long or was swing trading or other kind of style trading came into the market. So you have two forces of demand that are interacting on the charts. And that's best picked up, best seen on the lower frames. So in the example of a obvious, well-known, higher time frame support or resistance level, once that breaks, it is seen clearer with more information, with volume in real time, momentum. If you're looking at the S&P futures, internals, tick, breadth, etc. So those can be confirmed and the trades can be taken with more confidence. A breakout of a 5 minute chart may mean nothing. If it breaks a daily chart level that a lot of people are looking at, that will tend to cause motion, and that motion causes opportunity for intraday traders.
Is it safe to say that the longer the time frame, a yearly area of support or resistance or a yearly previous high or low is more important than, say, a monthly or weekly or anything else?
Absolutely. And it's almost like a hierarchy of time frames. More traders look at the higher time frames. So let's say if I'm a fundamental money manager and I don't really look at technical analysis that much, I may look at a 200-day moving average, or I may look at an obvious break to a new lifetime or new record high, say in gold or silver or any kind of stock. If I want to look to add a stock to my portfolio, I'm more likely to add it at those levels. So you have a confluence of, say, intraday traders, and we think of the grouping of traders as constituencies. The intraday traders, the swing traders, the longer-term position traders, and then combine that with fundamental investors. When a level on a higher time frame, very high, a yearly chart, monthly chart, for example, breaks, that tends to create motion, activity, and movement, and interest, volume, and momentum, and price movement opportunities on multiple constituencies, which translates on the charts as movement.
So it sounds like I need to be aware, even if I'm a short-term trader, I need to be aware of maybe a previous day high, a previous week's high. I mean, how many of these do you take into account before you actually execute that trade?
It's the bigger picture, and that's what we're looking at as a technical trader. It's sort of like this as a trader, it's the game. You put together the puzzle pieces. So it's just levels that people find important. A lot of technical levels are self-referential and create self-fulfilling prophecies. So as more people see them, they talk about them, they Twitter about them, they see them on TV, they look at them or hear them on the radio, and they begin to act. So they're not magical in and of themselves, but it just shows what different groupings are put together and how they react. Either a new high will force the bears or short sellers, those that think the market should go down, it will force a decision. They have to cover at some point because they're losing money. And other people on the sidelines decide, I may want to participate in this move. So that creates intraday movement on these different groupings, and that's what creates a lot of the opportunities for smaller time traders.
Corey, thanks for your time.
Thank you, Tim.
You're watching the MoneyShow.com video network.